Good afternoon, everybody. Hey, welcome to the end of summer starts today with the all the kids going back to school. I think everybody's back in school for the most part. I think anybody on the quarter system is probably waiting till mid-September, but most everybody's back in school. So it's kind of the unofficial end of summer. And this newsletter, it's going to be more of a video, if you don't mind. Um, and what I'm trying to work on is some of the math, some of the hard math that we're dealing with in valuations. I had a great conference I went to in early July. It was a lot of CEOs from some of the materials companies were in this, and it was great sitting around talking to some of these guys and finding where everybody's trying to move to in a sense in terms of what direction the economy's headed to based on the incredibly hard math of our deficits. So it was interesting, hearing their take, and they asked my take. And for me, is the explanation that the hard math is very difficult. And the math part of this, the equation, you take math and you take history, you combine them. It seems like it's really difficult to move forward without a lot of disruption, a lot of volatility. It's going to shake a lot of people out. A lot of folks at this point cannot take losses because their distributions are higher than they should be. It's going to be very, very difficult, probably a decade. Well, how we try to set up our firm, in the most recently, looking forward for the next 10 years instead of back at the last 40. The last 40 was a very easy decade with interest rates going from 23 on the Fed funds rate down to zero. And so we'll show a graph about that. So you take math and you take the history, and this looks like it's a very difficult situation for the foreseeable future, or maybe near term. Hopefully we can get through this without any really massive disruptions. But I think it's time to really kind of be careful with that. So I'm gonna share a couple screens and try to like highlight what's at least what we're looking at in this. We'll start with the first screen on really where the Fed funds cycle has been. So what we're sharing right now is just the screen up here with just the interest rate hike cycle. This is the interest rates moving up and interest rates moving down. The gray area is recession. So as you notice, we put a red dot above every rate hike peak and trough. So you see the peak, recession, peak, recession, peak, recession, peak, recession, peak going into the 80s. That's when Paul Volcker took the rates to 20 something percent. You see this graph here. And this goes from all the way from here all the way to zero. So I think the problem I would almost suggest anybody to look at is the mistake, the sin of the Federal Reserve keeping rates down here at zero for so long. We started raising them kind of going into COVID, then boom, little mini recession there because they spent massive amounts of money to get us out of COVID. So it's something to pay attention to. So again, this was the easy part. Dropping rates from 20 to zero is a nice huge tailwind to your sailboat, if you will. Couple of things to look at here, which is just the increase in delinquency rates on loans. Again, you see them tailing up, recession tailing up, recession tailing up, going into the great financial crisis. Long recession there because people are losing massive jobs back in the housing crisis. A little tail up going into COVID, and then you see a little recession there. So this is something I think we should be a little worried about. Why is everybody late? The economy's so great. Why is everybody so late on their loans? It'd be a missed a good conversation piece, I guess. You see this struggle with housing. Everything's so great. Why can't everybody afford a house? This is medium income for America. This is what it takes to qualify for a house. So very difficult situations, especially for younger families to start a family. So family formation is important. We start a family, historically, it's been about 28 years old. Now it's like 38 before someone can afford a house, even a decent sized house. So forget a starter home, it's just impossible these days. And let's look at the next graph. This one I've sent out. We'll look at this in the next slide down as well. This is just what Warren Buffett has used absolutely as the Buffett indicator, which is the value of our stock market above or below the value of our GDP, gross domestic product. So this is just saying, hey, we're extremely significantly overvalued. We've gone over this before in some of the graphs we sent out. So where are we going from here? I mean, what's the future for the stock market if we're this overvalued? I mean, maybe the economy can start growing at 8%. That would take care of some of the excess, but that's with everybody broke and late on their loans, it's hard to see us going to just rotate into this huge, massive upswing for the economy. So this is another way of looking at the graph here. I think I've gone to this with just a standard deviation method. We're 200 plus, 209% above normal valuations. So we've been here before, peaked here in the 65 area. The Dow was 1,000 points roughly here. Didn't break back above 1,000 until like 1983, where it stayed above 1,000. I've gone over that with a lot of you folks in the office. Same thing here when George Bush took over right here. Again, two standard deviations above normal valuation. This is normal in here, this middle line there. Right here, we are at excessive levels of valuation. So ask yourself, what would be coming from the stock market going forward? Well, it's highly overvalued. So we can't find a sector that's necessarily undervalued. So that's why we're very, very cautious with the allocations at this current point. You don't see the future returns being as robust as I think one would expect. So we've gone over this slide right here is an interesting slide. This is just what it takes to recover from a loss. So if someone's going into the market, hey, I can recover from a loss, I'm good. I want to stay long term. That's all good depending on the age and proximity to your long-term horizon. Most Americans don't have a long-term horizon. They lose some money. They will want to get out of the market and be protective. So the fear and greed between the two the irrational emotions that run the market, it'll start to hurt people. So you see that having loss ratios that are kind of mellow in here, not lose 1%, it doesn't take much to get back. Lose 5, not much. But you start losing larger amounts, 50%. You lose 50%, you go from 1 million to 500. It takes you 100% gain to get back. So you lose 40, it takes you 67. You lose 30, it takes you 43. So the math gets a little bit difficult on these losses. That's why we're trying to encourage people to at least be cautious. We all want to be optimistic that things are going to work out just fine. I remember a lot of conversations we had during COVID. Hey, we hope it's only 2 weeks. We hope they get a vaccine. We hope, so hope is not necessarily an investment strategy. So in this case, no, we're hoping we don't have these losses that don't accelerate. We haven't had them yet, but if you look at that valuation from that previous chart, if we're roughly 50% overvalued, I'm not saying the market's going to drop 50%. We don't have any predictive power because we don't know what's going to happen next. So we want to stay away from being in the prediction game, but we want to make sure that we're at least signaling why we would be more cautious and why anybody should be more cautious in this environment. It seems like it's going to be pretty difficult. Another graph, this is just the credit sector. So I would ask this question. This goes back to the 60s. If we're so strong in the economy, why is our consumer debt so large, almost parabolic? So one of the next slides is about savings rates. This is incredibly insane. I mean, people are buying couches on zero financing. We'll buy a couch and we'll pay for it 3 years at zero interest rates. You can make one late payment, you're back at 33% charge on that credit card. It just seems kind of dangerous. If the economy is so great and jobs are so good, that shouldn't be the number we're looking at there. Kind of see that also. And this is another way of measuring the hard math of the market valuation. So it's called the CAPE ratio. And so we're kind of at these peaks. You saw this peak in 2000. We're up here, and then we had a recession and a large drawdown, especially in the NASDAQ stocks. Right as we're kind of coming back from this loss, the kind of started peaking up in here, getting a larger recession with the housing crisis. I mean, like nothing's been fixed, but here we go again. So now we're at these peaks again, getting up to here. So this is not predictive. It's just you kind of a reason to be cautious with what you're looking at in terms of future returns here. Next graph here, which I think is important. This is sad. I mean, this is America. The top graph is personal savings rate. So you go back to the 50s, you go through the 60s, even coming into the 80s, 80s, saving rates were fairly decent. So even through the 70s, with all the inflation, people were saving more money. And now, what we're saving right now, it's 8% was the average. We're saving 3.6%. Just, and the other side of this is the consumer credit I just showed you out there, 5.9 trillion. That's, again, we should have more savings and less in debt if you want to have a good, strong, robust economy. No doubt about it. This is just more of a graph for the Mag 7. The Mag 7 in here. That's all the tech, all the AI up here. The average market's down here. So without these 7, this is what the market would be pulling in right now. So if you take out those huge Google, Amazon, Apple, Netflix as part of that, there's a good 7 stocks in there. Netflix, Tesla, Meta, or I guess Facebook. I would say I'm on Facebook, but if Facebook went away, I think I'd be okay. So I don't really need Facebook, to be honest with you. Let's look at another unexciting to anybody listening to this video. It's the rate of increase for student loans. This is February of 2020, so this is February of 2025. The jump in delinquencies for people 90 days past due on student loans. Student loans are not just dischargeable in bankruptcy. You got to pay it. There's no way out of that. So a lot of these students who took out huge loans to get probably degrees that aren't worth much and now have to pay it back. They probably went out and bought BMWs or some kind of car, automobiles. They thought they were going to get these loans forgiven or something like that. So its rate increase is pretty significant, and just in terms of delinquency there. And that's again now it's a headwind for the economy, not a tailwind for the economy. One of the last slides we'll show you. This is more the 70s. So I've talked about this with a lot of folks in the office. Just what did the 70s look like? It was extremely volatile as inflation raged. And the end of the 70s, we had that huge inflation throughout that decade. So marked by just peaks and troughs. We couldn't get the Dow over 1,000 points in the 70s. So, lose 25%, it kind of rolls up, loses 32, kind of moves up, all this. That was a 73, 74, oil embargo from OPEC, lost 45% roughly there. Moves up minus 25, moves up minus 19, moves up minus 24. And I don't think any Americans are going to be ready for this kind of scenario, if indeed it does play out. And the challenges with the Federal Reserve, they're kind of running a hedge fund, if you will, with the economy. Just keeping that rate in that first slide at zero for so long has elevated every other asset class out there. It's elevated debt, that's a bubble. It's elevated the stock market, that's a bubble. It's elevated commercial property, that's a bubble. And even to some extent, residential property as well. So I've never seen these many bubbles. It's like a balloon, as Beth said, waiting to be popped, a bubble waiting to be popped up there. We've sent this chart out as well, way back when. This is just yield curve inversions, the 10 and 2-year yield on treasuries. And so this distortion here, typically after these distortions here, we have a recession here, and we haven't had one yet. I'm not saying a lot of Americans are already in a recession. I'll tell you that right now. There's a lot of people that are running out of money. If they have anything in savings, they're running through it pretty quick. Pay for air conditioning in a little apartment in Fresno, $800 a month in the summer heat is really hard for people to handle. I don't know why that doesn't come out better in the inflation data. It does not. So I think that's about it for the charts. I hope this is helpful. But when we talk about why we're so cautious mathematically, it is because the math is very difficult here, and so I'm really urging folks to be very careful. We have done a pretty, I think, good amount of work in the second quarter working on reallocation methodology and reallocation for the accounts, moving into some of the things that have a bit more protective, we would hope, meaning that's more of the metals and the things that are more needed in the economy. Like I said, Facebook, I could do without. I don't know if I need Netflix. If I want to build a house, I need copper. I need the metals that would run the economy. So we're kind of elevating some of those as well. So we'll be, if we haven't contacted you already, we'll be, having staff, either Vance or Jeanette, kind of reaching out, or myself reaching out to kind of go over some of these allocations that you'll be seeing coming into the fall. Labor Day is really 2 weeks away, and that's really kind of the start of the second half of the year as everybody gets back to work. Well, hey, what's going to go on next year? And we'll see how that works out. So anyway, if you guys have any questions on any of these graphs, please reach out in the comments. We would love to hear from you. And hopefully we're just trying to make sure you're educated about the risks that at this point are very, very real and very, very material. Like I said, the distortions of COVID, zero interest rates for 10, 12 years. I mean, that is a huge distortion that we have not seen. The debt is a huge distortion. That's a mountain that we can't move. We cannot pay off that debt. So that'll be monetized. So anyway, I hope you guys all doing well. I hope you guys all had a great summer. Now that everybody's back to school. And if you guys have any questions, please by all means reach out. You guys take care. Thanks.